In the summer of 1998, Wall Street was riding high. The markets were thriving, confidence was strong, and the smartest people in finance were printing money. And then, a single hedge fund nearly brought the entire global financial system crashing down. Long-term capital management, LTCM, wasn't your average investment firm. It was a fortress of genius. Founded by Wall Street legends and powered by Nobel Prize-winning economists, LTCM believed they had cracked the code to low-risk, high-return investing. They were untouchable until they weren't. Within weeks, a $4 billion fund lost nearly everything. Banks panicked, the Federal Reserve rushed in, and behind it all was one simple truth. Even the most brilliant minds can be blinded by their own models. This is a story of long-term capital management, the $4 billion bet that nearly broke Wall Street. Could you have seen it coming? Let's find out. It started in 1994. John Meriwether, the former vice chairman and bond trading savant at Salomon Brothers, had built a reputation as one of Wall Street's top minds. After a scandal at Salomon ended his run, he wasn't done. He wanted to build something bigger and something smarter. So, he assembled a dream team. His new hedge fund, Long-Term Capital Management, brought together some of the biggest brains in finance. Two of the most notable, Myron Scholes and Robert Merton. Yes, the very economists who helped develop the Black-Scholes-Merton model, the same one that revolutionized how markets price options. These men weren't just academics, they were Nobel Prize winners. Their goal? Use quantitative models to identify pricing inefficiencies, arbitrage opportunities in global financial markets. If two bonds were similar but trading at different prices, LTCM would bet they'd converge. If volatility seemed overpriced, they'd sell it. If equity pairs diverged, they'd bet on reversion. It wasn't gambling, it was simple math, and the math looked flawless. Investors lined up, LTCM raised $1.3 billion in capital. With their reputation and strategy, banks practically begged them to borrow, and borrowed they did, leveraging that $1.3 billion to control over $100 billion in assets. This was financial rocket science. What could go wrong? Well, for a while, nothing. In its first full year, 1995, LTCM posted near 40% returns. In 1996, another near 40%. Their Sharpe ratios were through the roof, and their risk models showed minimum downside. Wall Street drooled. LTCM wasn't taking big directional bets. Instead, they bet on relationships. Statistical arbitrage between similar instruments backed by mountains of data. Most trades were tiny in profit, mere basis points, but they were placed in hundreds of millions, sometimes billions. They traded government bonds, interest rate swaps, equities, and even emerging market debt. Their model said these markets would behave predictably, that no matter the turbulence, things would revert to the mean. It was elegant, it was efficient, and it was working. By 1998, LTCM had grown to $4.1 billion in equity capital. But thanks to leverage, they held over $125 billion in assets and over $1 trillion in a notional derivative exposure. That kind of exposure, it only works if the markets behave. Then came the summer of 1998. In August, Russia shocked the world. The Russian government defaulted on its debt. The ruble collapsed. Foreign investors rushed for the exits. Emerging markets plummeted and volatility exploded. LTCM's worst-case scenario became reality. You see, the fund had built positions assuming that various spreads between treasuries and corporate bonds between developed and emerging markets would narrow. But now, in a panic, they widened. Worst of all, LTCM's models had assumed diversification. But when fear grips the market, everything correlates. Investors sell what they can. Everything drops together. Bonds, stocks, currencies, commodities, you name it. LTCM lost over 40% of its capital in August alone. The Genius Fund was imploding. LTCM losses weren't just a bad quarter. They triggered a crisis. Because of their size and leverage, LTCM problems were the bank's problems. Merrill Lynch, Goldman Sachs, Bear Stearns, Credit Suisse all had exposure. LTCM trades were intertwined with the global financial system, and as prices moved against them, LTCM received margin calls. A margin call is when your broker demands more collateral. If you don't deliver, they sell your positions at any price. LTCM didn't have the cash. Their positions were huge but illiquid. Selling would crater the markets further, but not selling meant they default. It was a doom loop. By early September, LTCM had lost nearly $4.6 billion. Its equity base has been nearly wiped out. The smartest people in finance were on the brink of total collapse. On September 23, 1998, the Federal Reserve Bank of New York held an emergency meeting. It wasn't just about LTCM. The entire financial system was at risk. If LTCM failed, it would trigger fire sales. Banks would suffer billions in losses, liquidity would vanish, trust would evaporate. So in a closed-door meeting, 14 major financial institutions, including Goldman Sachs, Merrill Lynch, and JP Morgan, agreed to inject $3.6 billion into LTCM, not to make money, but to prevent a collapse. The bailout didn't use taxpayer funds, but it was clear LTCM was too connected to fail. The fund survived, but just barely. In the months that followed, LTCM wind down. John Meriwether stepped aside, the fund's assets were liquidated. Scholl's and Merton's reputation took a hit, and Wall Street was shaken. Congress held hearings. The SEC and other regulators probed the case. How could a private fund accumulate so much leverage hidden from public view? The LTCM crisis triggered serious reforms. Banks tightened their prime brokerage standards, risk models were questioned, and the Fed took a more active interest in hedge fund exposures. Wall Street had been humbled by its own creation. So what do we take away from LTCM? First, leverage is a double-edged sword. It magnifies gains, but also losses. Second, models are only as good as the assumptions behind them. And in a crisis, those assumptions break. Third, correlations can break down crisis. What should diversify, you can suddenly compound risk. Fourth, systemic risk can lurk in places regulators can't see. LTCM was a black box. When it cracked, everything was exposed. And finally, markets have a memory. LTCM's failure shaped risk management for decades, and when 2008 rolled around, many remembered 1998. LTCM's collapse wasn't just a failure of finance, it was a failure of imagination. The brightest minds believed they couldn't be wrong. They were. So here's the question. Would you have trusted the math or questioned the risk? Thank you for watching. If you found this video insightful, don't forget to like, subscribe, and share your thoughts in the comments. We've got more deep dives coming your way, so hit that bell to stay in the loop. This was the $4 billion bet that nearly broke Wall Street, and it might not be the last.